A man may possess the finest analytical mind in the world. He may have a system that is technically sound. But if he has not first conquered the powerful and primitive emotions that are his birthright, he is doomed to fail. Wall Street is a battlefield that is littered with the bones of brilliant men who were destroyed by their own human nature. This is an analysis of that internal battlefield. It is a clinical dissection of the great emotional traps that are responsible for the ruin of 99 out of every 100 men who attempt to make their living from the market. To understand these traps is to take the first and most critical step toward avoiding them. These are the unseen currents that pull a man off course, the psychological whirlpools that drag him down into the abyss of failure. They are subtle, powerful, and they are always waiting to exploit a moment of weakness or a lapse in discipline. The principles required to navigate these dangers were not learned in a classroom, but forged in the fires of immense, soul-crushing losses. They are the hard-won wisdom of a lifetime of study. Many of these timeless lessons, learned at the cost of millions of dollars, were masterfully chronicled by Edwin Lefebvre. A link to his essential work, Reminiscences of a Stock Operator, now with a unique, detailed, chapter-by-chapter analysis from Max Davidson, is left in the description below this video. This new analysis is specially designed to make the timeless wisdom of the book powerfully relevant to the modern reader. The speculator faces two primary emotional forces, two great and powerful deceivers that stand ready to sabotage his every sound judgment. These are his oldest and most intimate enemies, hope and fear. They are the twin assassins of a speculator's capital and his peace of mind. Hope is the siren song of the losing trade. It is the warm, soothing whisper in a man's ear when the tape is telling him a cold, hard truth. He enters a position, and it moves against him. His analysis is proven wrong. His rules demand that he sell. But hope intervenes. Hope tells him, it is only a temporary reaction. It will come back. Hold on. It is the most expensive and most dangerous word in the entire lexicon of a speculator. A trade that requires hope to be profitable is a trade that is already lost. Fear is the other great enemy. It is the saboteur of the winning trade. A speculator enters a position correctly and it shows him a handsome profit. The trend is strong, the stock is acting right, and all the signs are bullish. But fear begins its work. Fear is the nervous, anxious feeling that the profit will disappear. It is the terror of watching a good gain turn into a small one, or even a loss. It screams at a man to take the profit and run to secure the small, sure thing rather than having the courage to sit tight for the great, decisive move. The undisciplined speculator, therefore, finds himself in a perfect and diabolical trap of his own making. He is hopeful when he should be fearful, holding on to his losers. And he is fearful when he should be hopeful, cutting short his winners. His emotional responses are the exact inverse of what is required for success. But the emotional traps do not end there. A more subtle and perhaps even more dangerous set of psychological pressures emerges not from the daily fluctuations of the market, but from the speculator's own recent results. The emotions that follow a great victory are often more perilous than those that follow a defeat. A man who has just executed a great and successful campaign, who has made a vast fortune from a single brilliant insight, is in the most dangerous position of his career. He is a man who has been seduced by his own success. He is suffering from the intoxicating poison of hubris. He begins to feel infallible. He looks at his swollen bank account and sees it not as the result of a sound method applied correctly, but as the proof of his own inborn genius. He forgets that he is a humble student of the tape and begins to see himself as its master. This overconfidence, this arrogance, is the prelude to every great downfall. It is the mental state that causes a man to abandon the very rules and principles that made him successful in the first place. He begins to believe he is the exception, that the old cautious rules are for lesser men. He will take on positions that are recklessly large. He will neglect his stop losses. He will begin to trade on his own feel for the market, on his own sense of his own genius, rather than on the cold, hard, impersonal facts of the tape. He is a man who is preparing his own financial grave. The other side of this coin is the emotional state that follows a great and painful loss. Here the enemy is not arrogance, but a desperate and emotional desire to win it back. The speculator has been wounded both financially and psychologically. His ego has been bruised. He is no longer thinking about the market with the cool detachment of a scientist. His mind is consumed by a single burning and irrational need to make back the money he has lost, and to do it now. This is the desire for revenge against the market. This is the state of mind that leads to the most reckless and impulsive of all decisions. The trader will double his bet size. He will abandon his entry signals and begin to gamble on any small movement. He is no longer a speculator. He is a frantic gambler, throwing his remaining capital at the wheel in a desperate attempt to recoup his losses. The market does not care about a man's need for revenge. It will punish this emotional recklessness with the same impersonal efficiency with which it punished his previous arrogance. The desire to win it back quickly is the surest way to lose everything that remains. Jesse Livermore, throughout his long and turbulent career, was a man who experienced these emotional extremes in their most pure and most devastating forms. He made fortunes that were the stuff of legend, and he lost them with a speed that was equally breathtaking. He was a man who was forced, time and again, to confront the fact that his greatest enemy was not the manipulations of the insiders or the irrationality of the crowd. His greatest enemy was Jesse Livermore. He came to understand, with a clarity that was paid for with millions of dollars, that the great challenge of speculation is not in reading the market, but in reading oneself. It is a battle for self-mastery. He acknowledged that all his great failures were the result not of a flawed analysis, but of a lapse in his own psychological discipline. He had allowed hope or fear or greed, or most often the intoxicating pride of a great success, to override his own proven scientific rules of operation. It is from this deep and painful self-knowledge that his entire system for emotional control was forged. His rules were not just a set of technical guidelines for trading. They were a complete and total philosophy for the management of the human mind under conditions of extreme pressure. Let us then examine these rules, these great principles of emotional control that he learned at such a terrible cost. The first rule, the antidote to the impulsive desire for action, is this: one must never trade unless the market itself provides a clear and unambiguous signal. A speculator must not trade because he wants to trade or because he needs to make money. He must trade only because the evidence of the tape tells him that the time is right. This requires the difficult and profound virtue of patience. He must be willing to sit in cash for days, for weeks, or even for months, waiting for the one perfect, high-probability opportunity to present itself at a pivotal point. This discipline of inaction is the great cure for the gambler's itch. It removes the speculator's own ego and desires from the entry decision. The decision is not his to make. It is the market's. His job is simply to wait for the signal and then to act upon it with speed and decisiveness. It is in these moments of calculating risk and managing exposure that the true work of a speculator is done. The emotional desire to bet big on a promising idea is a powerful and ever-present enemy. It is the gambler's impulse, and it must be conquered. It is for this reason that a constant study of these first principles is not a luxury, but a necessity for survival. A return to this channel, to this video and others, especially after a series of painful losses has clouded one's judgment, serves as a vital recalibration of the professional, unemotional mindset. The second rule of emotional control is the swift and merciless cutting of a loss. This is the great antidote to the poison of hope. A loss is the market's verdict that a judgment was wrong. The speculator must accept this verdict without argument. The stop loss is the pre-committed, unemotional decision to never allow a small error in judgment to grow into a catastrophic financial wound. It is the surgical removal of a mistake before it can metastasize. The man who can take a small loss with a sense of professional pride, who sees it not as a personal failure but as a successful execution of his risk management plan, is a man who has achieved a high degree of emotional control. The third rule is the principle of intellectual independence. The speculator must never, under any circumstances, trust in tips or in the opinions of other men. To do so is to surrender one's own mind, to become a second-hander in the game of thinking. The desire for a tip is an emotional weakness. It is a desire to avoid the hard work of analysis and the heavy burden of personal responsibility. The professional speculator is a lone wolf. He does his own thinking, he makes his own decisions, and he accepts the consequences, both good and bad. He knows that a man who trades on another's opinion does not truly know the reason for his trade, and therefore he will never know the right time to sell it. He is a blind man being led by another. The fourth great rule of emotional control is the mastery of patience, not just in waiting for an entry, but in the entire conduct of one's speculative life. This is the discipline of treating cash as a strategic position. The amateur is always invested, always at the mercy of the market's whims. The professional knows that the time to be in the market is rare, and the time to be out of it is common. This patience is the ultimate form of protection. It protects a man's capital from the whipsaws of a trendless market. It protects his mind from the emotional exhaustion of constant, low-stakes gambling. It preserves his strength for the one or two great campaigns of a year where a real fortune can be made. In the final analysis, all of these rules are components of a single great overarching principle. The control of one's emotions is the control of one's capital, and therefore the control of one's own speculative destiny. A man can have the most brilliant analytical system in the world, but if he does not have the ironclad emotional discipline to execute that system without deviation, his system is worthless. The market will find his emotional weak point and it will destroy him through it. The true strength of a great speculator is not the size of his intellect, but the quality of his character. It is the ability to remain cool, calm, and scientific in the face of both a great intoxicating victory and a great painful defeat. It is the ability to be a dispassionate observer of the facts, a servant of the tape, not a master of one's own ego. It is the understanding that the great battle is never against the market. It is always and only against oneself. The man who has, through a long and difficult process of self-education, conquered his own human nature, who has banished hope, fear, greed, and ego from his operational toolkit, is the man who has truly mastered the game. He is the complete and unemotional professional. In the lexicon of the stock market, few words hold as much promise and peril as the breakout. It is the moment a stock, after a long period of quiet consolidation, suddenly bursts forth, shattering the boundaries of its previous trading range. To the hopeful eyes of the trading public, this is a signal of immense opportunity, a clarion call to action, the beginning of a swift and profitable move. Yet, for every true breakout that launches a glorious new trend, there are a dozen imposters, false moves or fake-outs that lure in the unwary only to reverse with brutal speed, leaving a trail of financial devastation in their wake. The great challenge for any speculator is to distinguish the genuine from the fraudulent. Jesse Livermore, the master speculator, understood this challenge more profoundly than any of his contemporaries. He knew that the vast majority of traders fail precisely at this juncture. They are driven by an eagerness to be the first, to catch the very beginning of the move, and in their haste, they mistake a flicker of activity for a true conflagration. They jump into a position based on a single candle, a fleeting moment of strength without waiting for the market's own deliberate, considered confirmation. This, Livermore learned, was not speculation. It was a blind gamble. And it was a gamble the market would punish with ruthless efficiency. His entire method was designed to solve this one critical problem: how to recognize a strong, legitimate breakout and avoid the costly traps of a false one. He did not seek to be the first man in. He sought to be the right man in. His approach was not based on guesswork or instinct alone, but on a scientific, methodical interpretation of the market's own behavior. He let the tape tell him the story, and he did not act until that story was clear, unambiguous, and confirmed by a series of logical, sequential tests. He knew that the real money was made not in the initial jump, but in the sustained, powerful trend that followed a genuine breakout. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The foundation of Livermore's breakout strategy was his concept of pivotal points. He was not interested in every minor level of support or resistance. He focused only on the truly significant price levels, the major strategic battlegrounds, where the long-term fate of a stock's trend would be decided. A pivotal point could be a stock's all-time high, the peak of a previous major swing, or the upper boundary of a long and well-defined consolidation range. It was at these critical junctures that he would watch with the intensity of a hawk. He understood that a move through a pivotal point was not in itself the final signal. It was merely the initial alert, the first sign that a major change could be underway. The true test, the thing that separated a real breakout from a false one, was what happened after the break. Did the stock follow through with power and conviction? Or did it falter, hesitate, and retreat? The character of the price action immediately following the breach of a pivotal point was everything. This led him to develop a series of mechanical, unemotional rules for confirming the validity of a move. After a stock broke through a pivotal point, it had to demonstrate what he called a proper continuation. It could not just limp across the line. It had to surge through it. To provide a concrete mathematical measure for this, he established his famous 3-6-point rule. For an individual stock, a breakout was not considered confirmed until the price had advanced at least 3 full points in the direction of the break. For his composite key price of market leaders, the required move was 6 points. Anything less than this was a danger signal. If a stock broke its pivotal point by a point or two and then immediately fell back, it was a classic false move, a trap for the impatient. Livermore would not only refrain from buying such a stock, but he would often take it as a signal to go short, recognizing the move as a sign of weakness and distribution, not of strength and accumulation. This simple numerical rule acted as a filter, protecting him from the market's most common deceptions. Another critical element of a true breakout was the behavior of the stock during its first natural reaction after the initial move. No trend moves in a straight line. After a strong initial surge, a period of pullback and consolidation is normal and healthy. Livermore would watch this reaction with intense focus. A genuine breakout would be followed by a reaction on significantly lighter volume than the advance that preceded it. This indicated that the selling pressure was light and that holders of the stock were not eager to part with their shares. The ultimate confirmation came after this reaction had run its course. A strong stock in a true new trend would quickly recover from this pullback and then surge forward again, pushing into new high territory with renewed vigor. This pattern, breakout on heavy volume, natural reaction on light volume, followed by a new advance to a new high, was the unmistakable signature of a legitimate, powerful trend. It was the market's own declaration that the line of least resistance was now decisively upward. Conversely, the signs of a false breakout were equally clear. If, after breaking a pivotal point, the stock experienced a sharp and severe reaction on heavy volume, it was a warning. If it then failed to rally with any conviction, or if its rally was weak and petered out below the old high, the breakout was a fraud. It showed that the initial buying power was a temporary anomaly, not the beginning of a sustained campaign. The inability of the price to recover and push forward was a definitive signal that the move had failed. Volume was another critical diagnostic tool in his arsenal. A breakout that occurs on a sudden, dramatic increase in trading activity is far more significant than one that happens on a quiet, low-volume day. High volume indicates that a major shift in ownership is taking place. It shows that there is a powerful, aggressive buying interest that is willing and able to absorb all the stock that is being offered at the old resistance level. It is evidence of a real and significant demand. A breakout on low volume, in contrast, is often suspect. It suggests a lack of conviction and can easily be reversed. The character of the follow-through was paramount. A strong breakout should not look back. The stock should move away from its old consolidation range and show no inclination to return. If a stock breaks out to a new high and then, within a day or two, plunges right back into the middle of its old range, it is a sign of profound weakness. It indicates that the breakout was not driven by genuine accumulation, but was perhaps a manipulative move designed to catch stops or distribute stock to an unsuspecting public. The inability of the price to hold its new ground is a clear signal to stay away. Finally, any legitimate breakout must be in harmony with the market's overall line of least resistance. A single stock attempting a major breakout while the general market is weak and trending downward is fighting an uphill battle. While it can happen, it is an exception, not the rule. Livermore always preferred to trade with the prevailing current. He sought to identify the leading groups in a bull market and then focus on the strongest stocks within those groups. A breakout is infinitely more likely to succeed if it is supported by a bullish tide in the overall market and its specific industry group. His legendary trades were a testament to these principles in action. Consider his campaign in Anaconda. He did not buy it because he liked the copper business or because of a rumor. He bought it for one reason. It had broken its pivotal point at $100. He recounted how the instant it sold at that price, he placed his order. The stock did not hesitate. It surged forward, climbing to 115 in a matter of days, confirming the breakout with a powerful, sustained advance. He repeated the exact same maneuver when it crossed the $200 pivotal point, capturing another massive gain. It was a perfect illustration of his method. Wait for the signal, confirm the follow-through, and ride the trend. His operations in U.S. Steel told a similar story. He began accumulating his massive 72,000 share line because, from the very start, the stock acted right. It was a leader. Its movements were strong and decisive, and every purchase he made was met with higher prices. The breakout was not a single event, but a continuous process of the stock proving its own strength, a process that allowed him to build his position with confidence. The true breakout in this sense was a sustained condition, not a momentary price spike. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not a monolithic doctrine, confined to a single individual. Jesse Livermore was a titan of the tape, a master of timing and psychology. Yet, the history of Wall Street is a pantheon of geniuses, each with a unique approach. Consider the fundamental power of a man like J.P. Morgan, who did not merely trade the markets but at times was the market, a stabilizer of panics whose influence was built on capital and control. Contrast this with a master like Nicholas Darvas, who decades later proved the timelessness of trends by developing his box theory, a brilliant mechanical system for identifying breakouts. The field is rich with other legends: the mathematical precision of Gann, the volume analysis of Wyckoff, the deep economic insight of Baruch. To explore this rich history of market genius, we have recently launched a new channel dedicated to studying the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding and learn from a multitude of different styles, the link to this new channel is in the description below. Join us there as we continue to uncover the timeless secrets of Wall Street. Perhaps the most powerful application of his breakout principle came in reverse during his masterful anticipation of the 1916 bear market. He was not looking for a single stock to break down, but for the entire market structure to crack. The signal came when he observed that the great leaders of the preceding bull market, stocks like U.S. Steel and Anaconda, had stopped advancing. They would have reactions, but they would not rally back to new highs. This failure to continue the trend was, for him, a breakout signal of the highest order, a breakout into a new bearish phase for those specific stocks. While the rest of the market was still buoyant, the generals had fallen, and he knew the army would soon follow. This was the ultimate confirmation, a sign that the great bull tide was finally turning. For Livermore, a strong breakout was never a single isolated event. It was not a mere candle closing above a line on a chart. It was a confirmed, validated movement, a symphony of signals playing in harmony. It was a breach of a major pivotal point, accompanied by a surge in volume, followed by a powerful and sustained continuation of the move. It was confirmed by a shallow, low-volume reaction, and reconfirmed by a swift rally into new high ground. And above all, it was a movement that was aligned with the market's overall line of least resistance. His method was a filtration system, meticulously designed to separate the high-probability trades from the low-probability gambles. It was a defense against his own impatience, a bulwark against the siren song of false moves. He understood that the cost of missing a few points at the beginning of a move was insignificant compared to the cost of being drawn into a false one. The speculator's job is not to be a hero who catches the absolute bottom or top, but a professional who enters a trade only when the odds are overwhelmingly in his favor. Ultimately, the truest test of a breakout is the one that appears on your brokerage statement. A genuine breakout, entered at the correct psychological moment, should show you a profit almost immediately. It feels right. The market is flowing with you, not against you. A false breakout, in contrast, feels like a struggle from the very beginning. It does not move as it should. It hesitates, it falters, and it quickly begins to eat away at your capital. This, Livermore would say, is the tape's final, irrefutable verdict. Even with all these signals aligned, he never abandoned his core principle of prudent risk management. He never charged into a breakout with his entire line at once. He would first buy a small portion to test the move. If it acted as it should and showed him a profit, he would add another portion, always at a higher price. He scaled into his position, allowing the market's own confirmation to justify his increasing commitment. This ensured that his largest bets were always placed on what was already a winning trade. This combination of patient observation, mechanical confirmation, and disciplined execution was the true source of his genius. It was how he recognized and profited from the great trends of his time. It is a profound irony of history that the most effective rulebook for the frenetic digital asset markets of 2025 was written by a man who never touched a computer and traded using a ticker tape and a chalkboard. Jesse Livermore, the master speculator of the early 20th century, operated in a world of steel, railroads, and cotton. Yet his understanding of the speculative game was so fundamental that it transcends time and technology. The names of the assets have changed from U.S. Steel to Bitcoin, from Anaconda Copper to Ethereum, but the game remains unaltered. The arena is different, a global 24/7 digital coliseum, but the combatants are driven by the same primal forces that have governed markets since their inception. Hope, fear, greed, and ignorance are the four pillars of the speculative world, as true today in the crypto era as they were a century ago. The average participant believes this time is different. They believe that blockchain technology, decentralized finance, and digital scarcity have somehow repealed the fundamental laws of human nature. This is the most expensive and consistently repeated mistake in financial history. The patterns of boom and bust, of euphoria and despair, are not a flaw in the system. They are the system itself, an endless echo of crowd psychology. Livermore's entire method was built upon this single, immutable truth. He knew that to succeed, one must not predict the future, but rather diagnose the present. His focus was never on what an asset should be worth, but on what the market, in its collective wisdom and madness, was actually doing. This philosophy is not just relevant to cryptocurrency. It is the essential key to surviving it. To fully grasp the depth of Livermore's methods, one must study the source. For the modern reader, there is no better guide than Max Davidson's meticulous chapter-by-chapter analysis of the timeless classic, Reminiscences of a Stock Operator. It translates the lessons of a bygone era into a clear language for today's markets. A link to this indispensable resource is provided in the description below. The cryptocurrency market, in many ways, is the ultimate manifestation of Livermore's ideal trading environment. He sought out volatility and clear, decisive trends. He thrived in markets that offered the potential for enormous, rapid price movements. The stock market of his day was a placid lake compared to the raging ocean of digital assets. Here, breakouts are not gentle upward drifts, they are explosive, vertical ascents. He taught that the big money is not made in the day-to-day wiggles, but in identifying and riding the great swings, the major trends. The crypto market is a market of great swings. It moves from profound despair and neglect to breathtaking euphoria in cycles that are compressed and accelerated. It is a market that richly rewards the patient speculator who can correctly identify the beginning of a major move and has the courage to stay with it. This is where his concept of the pivotal point becomes so incredibly powerful. A pivotal point is a moment in time when the character of a market changes, when a stock or an asset breaks out of a long period of consolidation and announces its intention to begin a major move. Think of Bitcoin spending months trading in a range below its previous all-time high. The noise within that range is meaningless. The signal, the pivotal point, is the day it breaks out above that high on a massive surge of volume. That breakout is the market's verdict. It is the declaration that the forces of demand have overwhelmed supply. For the Livermore speculator in 2025, this is not a moment for fear that the price is too high. It is the moment of confirmation, the starting gun signaling that the true move is just beginning. To buy this strength is the core of the method. But to act on that signal, you need an instrument as sharp and reliable as your analysis. Because in those critical seconds of a breakout, when volume is flooding in and price is moving vertically, the reliability of your exchange is everything. You need a platform that won't freeze, that executes your order instantly, and that doesn't erode your profit with high fees. This is precisely what Kraken Pro was built for. It's the professional-grade engine designed for speed and low-cost execution, ensuring that when the pivotal point arrives, your only focus is on the trade, not on your tools. Having an account there, funded and ready, is like having your finger on the trigger when the target appears. The link to get started is in the description. But having a professional tool is only half the battle. You must also avoid the amateur mindset. The amateur in the crypto space does the opposite. They hunt for assets that are down 95%, mistaking a catastrophic loss for a bargain. They are buying weakness and hoping for a recovery. Livermore knew this to be a fool's errand. He exclusively bought strength. The principle is simple. A rising price is a sign of health and demand. A falling price is a sign of sickness and liquidation. Your job is not to be a doctor to a sick asset. Your job is to ride the healthiest horse in the race. The crypto market makes it brutally clear which assets are healthy and which are not. The line of least resistance in crypto is a powerful and visible force. During a bull market, the path of least resistance for the market leaders is decisively upward. During a bear market, it is catastrophically downward. To fight this trend, to try and short a market leader in a bull run, or to buy a collapsing asset in a bear market, is to stand in front of a freight train. The evidence for these moves is found in price and volume. A breakout of a key resistance level in an altcoin must be accompanied by a dramatic increase in volume. This is the footprint of large capital. It shows conviction. A low-volume drift above a resistance line is a warning sign, a potential trap. The crypto charts, with their transparent on-chain volume data, provide this evidence with greater clarity than ever before. But with this immense opportunity comes an equally immense risk. The very volatility that creates fortunes can extinguish them in a matter of hours. This is why Livermore's most important principle was never about maximizing profit, but about the unwavering preservation of capital. This rule is 10 times more critical in the crypto market. In the stock market of his day, a 10% loss was a serious matter. In the crypto market of 2025, a 10% move can happen while you are getting a cup of coffee. Without an ironclad system of risk management, a speculator in this space is guaranteed to be wiped out. It is not a question of if, but when. His cardinal rule was to cut every loss quickly. Your first loss is your best loss, he would say. The moment a trade went against him beyond his predefined point of risk, he was out. No questions, no hesitation, no hope. In crypto, this is the single most important survival skill. A small loss, if not cut, can and will turn into a 50, 60, or 90% catastrophe with terrifying speed. This leads directly to his other sacred commandment: never average down. To add more money to a losing position is the ultimate act of ego and hope destroying a trading account. If you bought a token at $10 and it drops to $7, your initial judgment was proven wrong by the market. To then buy more at $7 is to double down on your mistake, reinforcing failure. In the unforgiving world of crypto, this is financial suicide. The speculator must define their point of invalidation before ever entering a trade. If you buy the breakout of an altcoin at $5, your stop loss might be a close back below that breakout level at $4.50. If that price is hit, you do not reconsider. You do not wait. You execute. You take the small loss and you preserve your capital to fight another day. The market is telling you that you were wrong, and you must have the humility to listen. This level of discipline is not natural. It must be forged in the fires of experience and loss. For those of you navigating these treacherous markets, for those who have felt the sting of a liquidation and the panic of a collapsing position, this channel is here to serve as your anchor. Subscribe and return to these first principles. When your discipline is tested and your emotions are running high, come back here to ground yourself in the timeless logic that separates the professional from the gambler. Another of Livermore's great lessons was the importance of the trading venue itself. He began his career in the bucket shops, which were essentially gambling dens that took bets on stock prices without ever actually buying the stocks. They were notorious for cheating their customers. He learned that to succeed, he needed to be in a legitimate arena, the New York Stock Exchange, where prices were real and trades were honored. The parallel to the crypto market of 2025 is stark and direct. The modern-day bucket shops are the unregulated offshore exchanges with questionable reserves, the anonymous DeFi protocols that can be rugged overnight, and the platforms that offer insane leverage to lure in the unsophisticated. They are traps designed to separate the impatient from their capital. Therefore, the choice of your trading arena is the first and most critical act of risk management. The modern equivalent of the NYSE is the established, regulated, and audited exchange. Choosing to trade on a platform like Kraken is not a minor preference. It's a foundational strategic decision. Founded back in 2011, it is one of the oldest exchanges on the planet and has built its reputation on a security-first mindset. It has famously never been hacked, In a world of uncertainty, Kraken provides stability through regular proof of reserves audits, proving your assets are backed one-to-one. Just as Livermore left the bucket shops for the NYSE, the modern speculator builds their career on a trusted foundation. Using a platform like Kraken isn't just about placing trades. It's about eliminating the one risk you should never have to take, the risk of your chosen venue. This foundational security extends to your flow of information. Livermore quickly learned to distrust tips and inside information. He knew the only reliable source of truth was the action of the market itself. The ticker tape told the whole story. The crypto world is a deafening echo chamber of tips, rumors, and paid promotion. The Livermore speculator of 2025 ignores this noise completely. They do not listen to influencers. They do not chase narratives on Twitter. They study the charts. They watch the price action. They monitor the volume. The chart of a coin contains all the information they need. The breakout from a long base on high volume is the only tip they will ever listen to. So, what does the successful crypto speculator of 2025 look like if they follow the Livermore model? They are, above all, patient. They spend most of their time in cash, observing the market, waiting for the high-probability setups to emerge. They are not afraid to do nothing. They know that cash is a safe and strategic position. They are decisive. When a true pivotal point appears, a major asset breaking a key level with massive volume, they act without hesitation. They do not nibble at the position. They establish their core line, knowing this is the moment of maximum opportunity. They are disciplined. Their stop-loss is predefined and absolute. They cut their losses without emotion, viewing them as a simple business expense, the cost of probing the market for a major trend. They are not afraid to be alone in their opinions. They understand that the crowd is almost always wrong at major turning points. They trust the evidence of the tape over the consensus of the masses. They have the courage to sit tight. Once they are in a correct position that is moving in their favor, they resist the urge to snatch a small, quick profit. They know the big money is made by riding the full length of the major move. They let the trend be their friend. They focus their capital on the market leaders. In a bull market, they are concentrated in Bitcoin, Ethereum, or the one or two altcoin sectors showing the most explosive relative strength. They do not waste their money on laggards. They understand that risk management is not just a part of the game, it is the entire game. Without it, no strategy, no matter how brilliant, can succeed in the long run. The technology is new, the assets are digital, and the speed is incredible. But the underlying principles of speculation are ancient and unchanging. To master the cryptocurrency market of 2025, one does not need a new set of rules. One simply needs to apply the century-old wisdom of the man who mastered the game itself. The best roadmap to the future of this digital frontier was, and remains, written in the past.